Yes. All right. So, okay, so the recording is on, I'm on, and you are linked. So we're going to start. So this is the our last session together. Terribly sorry for the delay between the last one and this one. Everything is becoming complicated, and nothing is getting any better anywhere in the world. As you know, I hope all is okay for you in Vietnam. I've been hearing news about the fact that maybe things were a bit complicated also in Vietnam, and they are definitely in France, and public authorities are struggling to find ways to move forward. And I can't say that France is doing such a good job of it, but that's another story, and it's not the object of our lectures tonight. So tonight's program is, so we're finishing off the compliance and ethics approach in business and financial regulation. The program for tonight will be first, because sorry, I'll just close the window. Avoid having obnoxious Paris sounds as I speak to you. So as I was saying, the program for tonight, to finish off our session, will be organized in the following way. First, we'll watch two short illustrations of the ethical behavior within business. I'm certain that we had not taken the time to look at them. These are very short scenarios, a bit like very short movies about different cases. So just two different cases, just to illustrate what we had seen about the ethical behavior within the firm's environment. So it's just an illustration and a refresher for what we've seen. Then we'll move on to, and I'll be pretty quick about this, about the corporate governance within financial services. I'll be very quick about financial services because, first of all, this is the last session, so we won't have time to go over all of the financial regulation. The other reason for that is that you are already familiar with financial regulation. So I'll just see the major chapters and to see, and this is what is important for us, to see how the compliance and the corporate governance falls within that legal framework. We'll be taking maybe a bit more time on one case, the Kobe Steel case, because it's an interesting case, a bit old now because it was in the late 1990s, or the years 2000, early 2000. So it's 20 years old now, but it still remains a very good example and topical example of how, as often is the case, the improvement of the compliance and the corporate governance, the ethical culture within the firm comes out of a crisis and of a scandal, or of a, let's say, of an accident. I think we can call it like that, to be euphemistic. So we'll have a look at the Kobe Steel example and case. Sorry. For that, you have a document that's in the files on the Canvas platform, and you can refer to it after. And there are other cases. We will not have time to go over all of them, but of course, I recommend that you take time in reading them, because they're short, 2, 3, 4 pages cases. They give you very concrete, very material examples of the implementation and of the way the compliance and ethical aspect will function within a firm. So I'll spend a bit more time trying to explain where we stand today in 2020 regarding the embedding of ethical approaches, the business ethics, the corporate governance, the compliance methods that we already looked at. And that will bring us to the end of this last session. And of course, if you have any questions regarding the general assignment that you should have received by now, I assume, if you have any question, do not hesitate. At the end of the session, I can take any questioning that you might have regarding that. So do not hesitate to ask questions on that. And as always, of course, as we move along, if you have questions, please do come in and make those questions public so that I can try to answer. All right, so as I said, first we will start. I'm just looking for my link. Oh, there it is. We will watch 2 examples, but I'll stop in between and talk about it. 2 examples of how you embed the ethical behavior within a firm, or more, maybe more precisely, more specifically, how do these ethical dilemmas can come up in a normal, real life situation, knowing that real life situations are always much more complicated to grasp from the start, because you're in the middle of the action, you're caught in the with the action, and it's much easier, of course, to read a paper that pinpoints the ethical aspects. It's much more complicated in real life, and these short movies that were actually designed and conceived and realized by as I'm talking, I'm typing in the link, by the Hong Kong Authority. Okay, it's in English. I'll see if I have subtitles. Nope. Okay, well, no subtitles. All right, so I'll switch off my speaker, of course, during the video, so that there are no echoes. And so this is the first the first movie about the ethical. I hope it's the correct one, about the an ethical situation. Okay, wait, there's a mistake here. That's not the correct one, so wait. It's just there. Oops, so here it is. Let me see, where do I have this? Ah, there. It's not the correct link. So normally this microfilm series on business ethics, and the first one is called Separate Business from the Personal. Let me see, get you the correct link up. Stop sharing the external video. Share an external video. Still not the good one. What's the matter? Oh, there it is. Okay, sorry. This. Okay, there we are, finally. Okay, so there it is. So as I said, this one is about separating business from personal life. Okay, so finally, here is the illustration. All right, so that was this. Wait, I don't know if you can hear me. Yes. Okay, so that was the first example, which is a very classical example on how I say classical. It doesn't happen every day, but and you see the difficulty that you can have um, when the personal relationship might infringe or get in the way of your rational objective decision making. That actually illustrates why you need to have a structure with guidelines, with manual, with a compliance officer or an ethical officer, or whichever way you want to call him. Because one of the things that obviously often is a difficulty within the firm is that as far as close relationships are necessary, and it's also a question of trust, you work with people that you trust, it is also the same relationship that might prevent you from seeing things or deciding very objectively. And so the point here is that we're not, I think if you want to be rational, you can't change human nature. And there's no reason why we should try to change human nature. So you have to design institutions, or institutionally wise, you have to design structures, a framework that will be able to mitigate, to balance off those elements. And so that is an illustration of that actually vouches for having a structured embeddedness of your ethical guidelines and your corporate governance within the firm. Once again, if there are any questions, do not hesitate to come up with them. A second example here is also about the timing, and the name of that second one and last one that we'll be looking at, which is here again a 6 minutes long video, is about backing off a situation when you realize that it might take you into a direction that is not the one that you should be pursuing. And it's this idea that you have to pull back before it's too late. Now, here again, it's obviously something that rests with each of the individuals working in the firm. But if you have a framework, if you have clear guidelines, then you can actually have the nudge theory, so that you're helping people make the right choice, or at least not make the decisions that would put them in a situation that could be considered as unethical, and the unethical moving towards illegal potentially. And so this is this other example. It's about pulling back before it's too late. And here again, the scenario is a very real life type scenario. I mean, it's what you're going to see right now is something that obviously can easily happen in real life. Okay, so in this example, there are two different messages I like to bring your attention to. One is the one I'm interested with, is the ethical aspect, and it has to do with, of course, the fact that if you accept a bribe or an act of corruption, or even if it's a tentative, okay, even if it's not realized, then in most legal systems that is exactly the same. So it's important to realize those elements. The background of this is, of course, the fact that he needed money because he wanted to buy a car, and his own money was tied up in an investment scheme. That second aspect, and the message at the end, you have to manage your personal finances well and all that, has a very moral aspect to it. And I would set this a bit aside. It's not necessarily that's not part of the ethical of the compliance. That's a personal choice. But what is part of the ethical, the business ethics and the behavior, and the compliance aspect, is regarding the fact that you get caught, or you start moving down a path of accepting to do something against a personal reward, accepting to do something in your business for somebody that will reward you personally. And that is definitely something that becomes complicated, and that can, depending on the legal system, not only be considered as an unethical behavior, so that could have consequences within the firm, but can also have legal consequences, because, and that depends on your legal framework that will apply. You will usually have a set of rules regarding what is called bribery, corruption, that will play that will play a role, and that is usually a criminal charge, and not just a civil liability. So the point in those illustrations is to really show to what extent the ethical dilemmas, the fact that you have to consider the consequences of your choices, can actually happen in very simple day-to-day situations. Now, of course, in the first illustration, the actor was the player that was actually manipulating quotes and invoices and things like that, which was a very active role. But in the second example, basically, the father that wanted the car did not really engage into anything that seemed illegal. I mean, he just offered the services of a coach company. What does become illegal is that he gets paid for that outside of the firm. And so that refers to all the conflict of interest approach that you shall have, and that gives us the transition to look into the corporate governance, because it is through the actual organization of your corporate governance that you will have specific rules regarding conflict of interest, and those have to be linked with the ethical approach and the ethical compliance. Now, we'll be focusing here on financial and banking regulation, because that is the background of what we're looking at. So I'll be very quick on some of these points, okay, to reach the market discipline, because this is what we're going to be talking about, mainly corporate governance, and see how we have in today's world to understand corporate governance within a larger framework or context that is related to what we call sustainability and sustainable development, and CSR, corporate social responsibility. In today's world, especially after the COVID-19, well, not after, we're still in the middle of the COVID-19 situation, and then we're not really coming out of it yet. The situation we've been living in worldwide for the past now nearly 2 years is actually accelerating, pushing forward a change of mindset regarding, of course, companies and how they behave. And so corporate governance 10 years, 15, 20 years ago, and today is actually changing its nature. Or to say it differently, the demand on what corporate governance is supposed to deliver has evolved. Okay, and although that was quite clear in the literature about corporate governance, it is now becoming quite clear within the firms in the actual real life of corporate governance. And so there's a change here. Now, it's more specific within the financial sector because of what we call the Basel system. Okay, and just as a reminder, I know you're familiar with the Basel system, but the Basel agreement is about what we also call the Basel Accord, is about setting common standards for what are considered internationally active banks. Yes. Go ahead. Somebody raised their hands. I think Van Luan Huynh wanted to say something. Go ahead. No? Somebody just raised their hands. Van Luan Huynh, you wanted to say something? Okay, well, once again, do not hesitate. If you want to say something, that's a question. So, coming back to the Basel Accord, as I was talking about, that I was just talking about right now. So the first Basel Accord, of course, the early 1980s, was directed at international active banks. In practice, though, in reality, these standards have become the main standards, okay, of any of all of the banking regulation across the world. We know that, and we talked about this, the reason why this came into practice is because there was a necessity for bank regulators, supervisors, national bank supervisors, to actually coordinate their way of doing things, because they were confronted with similar issues at a time when we did not have all the internet possibilities, and so where the efficiency of their supervision was probably much more limited, in the sense that the territorial dimension of their capacity to supervise banks was much stronger than it is today, because today, of course, with with the internet and then on real-time exchange and flows of information, you can control and you can supervise, you can monitor internationally in a much easier way than you could before that. So that's a starting point. But of course, now we've evolved a lot. Gradually, this came out as the setting of the internationally accepted standards for banking regulation. But remember what we've said already, and I insist on this, the Basel Accord is not a mandatory rule for the national banking system. It is the national legislation. It is the national public authority that decide and that vote and organize the rules that will apply. So if you're a Vietnamese bank, you might, of course, be interested and look at what is decided at the international level in terms of standards, but this is just soft law. This is not what applies to you as a Vietnamese banking institution. Same thing for a French banking institution. It has to look at the French laws to know exactly what apply. But what we do find is that, and this is a consequence of and it wasn't decided by law, it's a consequence of the Basel work over time, is that it has become there's a consensus among states today that this is the source of the standards. And so most, if not all, of the national regulations are actually conceived and designed following the Basel Accord. And I know you studied this, so you know very well that the initial Basel requirement that was quite new was this idea that you needed a regulatory capital, that you needed a sufficient capital to cover your risk. It's the famous 8% ratio. Okay, this was what used to be called the Cook ratio. Then there was a Basel II Accord, and that's what's interesting for us, because the Basel I agreement was only focusing on the regulatory capital. And so on this idea that you needed a certain level of own funds, of own capital, to meet the risk that you were engaged into through your activity. So I'm not going to go into any details of that, because I know you're familiar with it. But that's the starting point. The first Basel Accord, 1984, of course, in the 20th century, was just about that. This approach, as much as it was necessary, quickly revealed itself to be short-sighted. It was not encompassing all the sources of risk, and it was not addressing all of the issues that financial institutions were confronted with. And so very quickly, in the literature, there are calls for an upgrading, a change of approach, and that will be the Basel II. And it is with the Basel II agreement that is pretty late, the end of we'll say the early year 2000s, and it will take time to be implemented. It is the Basel II agreement, which is still the one that's in force today, and we'll see the differences between Basel I, II, and III, and IV coming up. But the system, the new system, is about came to be with Basel II, and it is at that point that the supervisory requirements, the compliance approach, became a standard of the management of financial institutions. What's interesting here, and that you have to be aware of, is that the corporate management and compliance aspects were initially quite high in the financial sector, and it is only after, gradually, over the past 15, 20 years, that this concern about ethical business ethics, or ethical behavior, and corporate governance actually spread outside of the financial sector. But the origin of the compliance approach that is common now to all type of firms initially came within the financial sector, very quickly also to highly regulated activities like pharmaceutical, okay, because there were risk associated to that. But most of the initial conceiving and designing of the compliance approach was originated within the financial sector. Very quickly, just to finish off on this first part regarding the Basel, what are the pros and cons of the system? Because that's what's interesting about the Basel Agreement. As I told you, the Basel Agreement is not a mandatory piece of legislation. It is just an agreement that is, of course, designed by usually representatives of central banks, but it has no force against national legal systems. So when we think about this approach, which is a soft law approach, what are the pros and cons? Well, the pros, first of all, are, of course, that it was able to create an international standard, and the consensus came up. And one of the reasons why they were able to reach a consensus, it's because it was not a mandatory text. Because if you had to bring all the states together to design a regulation and to commit themselves, it probably never would have happened. Okay. Whereas these were only the directly interested parties, so the bankers, regulators that got together, and since they were not creating laws but just defining standards, there was less commitment, and so it was easier, and that became, by consensus, a worldwide recognized standard. So that's one of the pros of the Basel Accord. The other, and this is more substantial, the other pro of the Basel Accord is that it has definitely, it hasn't prevented financial crisis yet, but it has definitely contributed to the towards reaching a financial stability worldwide. Two of the important consequences of the Basel Accord were one, that it stopped this trend of having very, very low own fund levels in banks and in financial institutions. So the downward trend, as we used to call it, of regarding banks' capital level was stopped, and it's exactly the opposite today. That is happening. The other consequence, that substantial consequence that can be directly attributed to the Basel Accord, is that it has really pushed for a level playing field for the international banks. Okay. The other pro, although that is probably something that can be both a pro and a con, but the other pro was that the general framework was relatively simple. It was quite straightforward. Okay, it was just, you need to have a certain level of capital to meet your risk. Now, the cons, of course, one that really came out very quickly was that capital requirement doesn't capture all of the risk in an economy and all of the risk that financial institution can carry with them. The Basel Accord does not also address innovation in the measurement and the management practices regarding firms, and it's a bit of a rigid framework, and so that was a problem, because we know that financial services is a sector where there's a lot of innovation, a lot of new practices that come up. The first accord also had another negative aspect to it, is that it did not really take into account many of what we called credit risk mitigants. Okay, the specific situations that financial institutions are confronted with that might lower the level of the risk that they're incurring. And finally, one of the earliest and I would say most important criticism was that it was a bit of an OECD club rule at the start, because when it first started, it was mainly industrialized countries that were within the group of people that designed the Basel I. Now that has changed. That has changed, and it is again changing today. Sorry. So quite quickly, there was a need of a new Basel Accord, because the first one was considered as having some shortcomings. So we moved on to the Basel II. The time frame, very quickly, and give you an idea of how long the process is. There were talks about the need of a new accord early 1990s, during the 1990s. And it officially started only in June 1999, and the final Basel II Accord, the new agreement, was only adopted actually in 2004. Okay, because in April 2003 there was a consultation document on a new comprehensive approach that was validated by all the members of the Basel committee, And as I said, at this point in the years 2000, the members of the Basel Committee are not just the industrialized nation. Okay, they're regulators from all over the world in different types of economies, including, of course, emerging economies. But so you see, it took some time, and once that agreement was actually agreed upon by all of the members of the Basel Committee, it then again took a few years for the national authorities to implement this new framework into their legislation. Okay, and so that is why that's one of the default with the system, but it's probably something that cannot be avoided, is that it takes time to actually, from the initial designing to the actual implementation in real life economy and financial services. It takes quite a long time before things can actually roll out. What were the Basel II objectives? It had multiple objectives, but the one the one that I would like to stress out, because that's the one we're concerned with, which is regarding corporate governance, is that it really tried to encourage banks to improve their risk management capabilities, as well as a comprehensive coverage of risk. And the idea was that we need to come up with systems that will themselves address the risk issues. Why? Because it's impossible to design all the rules, the precise rules, because there are different contexts, because there are different organizations, because there are different legal systems. So there was this idea that you need to set up a framework that would incentivize the organization, the private organization, to address the different issues. And that is why what happened is that we moved to a 3-pillar organization. Okay, and that's the point I wanted to insist on, because that's what's interesting for us. So initially, in the initial Basel agreement, all you have are minimum capital requirements. What Basel II brings in is a second pillar called supervisory review process. Okay, and that is targeting national frameworks. And then it also came up with a third pillar, which is market discipline. And it is within market discipline that we will find the corporate governance requirements. And those corporate governance requirements have to be understood today in 2020 or 2021, to be honest, this year, but in the years 2020, as within their background, the CSR, the corporate social responsibility, and the sustainability goals that have become so important. Or to say it differently, the actual market discipline has evolved because we have to take into consideration the business ethics or the ethical considerations within the financial services. And I think that's what has really come out as new in the past few years, is the fact that although we haven't changed the requirements, the way they are to be understood has evolved. Okay, and so that's the general outline of Basel II. It is still the general outline that exists today. Now, of course, we talk a lot today about Basel III, but Basel III has not modified this architecture. What Basel III has done is actually to try to improve the minimum capital requirements, okay, which is the first pillar, the most traditional one. The second pillar, the supervisory review process, and the third pillar, market discipline, have not been modified directly, and the architecture is still that one. But what we're going to be focusing on are the following second and third pillar. I'm not going to talk about the first pillar because you're quite familiar with it. And so what do we find under the second pillar? We find this idea that we need to go beyond simple compliance with the basic rules. Okay, and supervisors, so the central banks, the national central banks, have to be and have to follow or should try to implement general principles about the supervisory review process. The third pillar that complements the first two is about corporate governance issues and disclosure issues, as we know that the information is important. And this is where we find today the implementation of these ethical concern within the corporate governance. Yes, I think Van Nguyen raised a hand. No, okay. Another mistake. Okay, I'll skip all this because you should be pretty much familiar with it. I just want to insist on the fact that pillar the supervisory review process sets guideline regarding the bank's internal process, because under that pillar, what we find, the accountability issues, the transparency issues, the risk management, all those, they relate to corporate governance. Okay, and corporate governance is what we're going to be looking at, is both specific to the financial sector, but also follows the general rules that we find in any corporate governance. Okay, Basel III, and I will not talk about Basel III because Basel III is only about a new capital requirement proposal and the liquidity aspects. Okay, and so these were implemented, but Basel III, what you have to understand, it is an adaptation. It is a strengthening of the Basel II framework. It is not a new framework. Okay, we still have the three pillars that will apply. So I'll skip this because, of course, you're familiar with that. You'll have them. So pillar one is about identifying credit risk, operational risk, trading book issues, and having the way of calculating and weighting the assets of the banks against those risks. Okay, that is more of a let's say a down-to-earth, very easy, it's relatively easy type of compliance because it has a mathematical approach to it, which is absolutely not what happens when you consider ethical aspects. And so when you look at the compliance requirement today within a financial institution, you really have to be careful about this fact that you have part of that compliance that is very technical, and part of it that is much more complex because it deals with business ethics, with disclosure procedures that are much less easy to quantify or to identify. Okay, so I'll move away from that, but you have that all in the slides, and that is definitely not what we'll be focusing on. We're going to focus on pillar 2 and 3. So pillar 2, as I said, is about about having what are called a supervisory review process, and that came out of Basel II because not all systems had this. And understand that behind the supervisory review process, what we have in mind is that, of course, you need to make sure that the capital is adequate, but banks have to go beyond capital requirement, and they have to look into the risk management techniques, and in order to monitor, to set their risk. And so the way we address risk in today's financial service is, of course, through the capital requirement, but also through other types of elements and organizational elements. The risk management process, the internal limits that are set, the levels of provision and reserve that are decided, and all that has to do with internal controls. And this is something we'll see just after, is what are the different factors that will discipline a firm, and we'll see that the internal controls play an important role, although there are also external controls. And so basically, the general objective is really to make sure that banks, they do have, and that's part of their corporate governance, they have the responsibility in designing and developing internal assessment process. And of course, you always have the capital requirement that you set, but it's really these internal assessments that are important. What are the areas that fall under Pillar 2? Of course, there are things that are related to the capital, but that are not well captured by the Pillar 1, so the capital requirement. For example, credit concentration risk is not well identified under Pillar 1. The internal process review should look at that. There are factors that are not covered by Pillar 1, but that are part of the risk, or at least they are factors of risk. And for example, interest rates, the business and strategic risk, the business cycle effects have to be integrated. And so the assessment of compliance has to go beyond the simple elements of the capital requirement that you find under Pillar 1. And that's where things become more complicated, because under Pillar 2, you can put a lot of elements, and that is the responsibility of the management to actually look into that, depending on their specific context. What also has to be understood, because the Basel agreement doesn't talk about this, but the future trend, and I would say that it's not just the future, it's the current, the ongoing trend, is that you have to embed within your compliance CSR. And we'll see just after what we mean by CSR, corporate social responsibility. So basically, we're talking about issues regarding social aspects and environmental aspects. All those elements have to be brought within the compliance approach. The 4 key principles of the supervisory review that you find within the Basel Agreement are simple enough. And if you look at them, they're simple enough. But of course, their actual implementation is much more complex. And that is where you have to refer to your national rules and regulation. If you break down those 4 principles, the first one is about having a process. Okay, having a process for assessing the capital adequacy in relation to risk profile and strategy. Okay, so this means that, as we talked about before, the compliance is really part of the risk management aspect, or at least compliance has to cover all of the risk management. The second principle that addresses national supervisors is that in order to have a well-functioning financial services supervisors, so the national supervisors should, this is what the agreement says, or the accord says, should review and evaluate the banks with a very large scope, not only on the sole capital. And so that brings to level 3 is that the Basel Accord is not dictating to national regulators how they should assess. It is just laying down a principle, which is that supervisors should expect the banks that they are monitoring to actually operate above minimum capital ratios and should be able to identify very broadly all the risks that they're confronted with. And so that encompasses the ethical aspects, okay, the risk of unethical behavior that could trigger some, that would have a consequence on the actual soundness, financial soundness of the firms. And finally, the 4th principle is this idea that what's important in financial services, and that is very specific about that activity, is to have a very early intervention. Okay, the 2008 financial crisis has really highlighted that point, is that regulators and state did not have the tools to clearly intervene at an early stage of the crisis and of the difficulties. And we know that in financial services, because of the systemic effect the quicker you can intervene, the quicker you can circumvent and close out the fire, then the better chance you have for a non-propagation of that fire. And so those are the four key principles of supervisory review. But you see that these principles are not principles that are addressed at banks, at financial institutions. They are addressed at supervisors and at national legislators to come up with a system that try to meet, or that at least are organized along these key principles. And that brings us to pillar 4, which is the corporate governance aspect. Now, the corporate governance aspect was introduced by the Basel II Accord under the 3rd pillar that talks about market discipline. Now, of course, today we would probably not use, let's say, exactly that same terminology. We have spoken only about corporate governance. But what we find under the term market discipline are the requirements regarding corporate governance. Now, these requirements are specified in different documents. One is the Enhancing Corporate Governance for Banking Organizations, which was released by the BCBS, so the Banking Committee on Banking Supervision, which is the official name of the Basel Committee, as early as 1999, and then revised in 2006. In 2010, there were new principles for enhancing corporate governance that complemented that. And in 2009, just before that, there was also another document that addressed market risk, the market risk framework, and that here again brings in guidelines regarding the internal organization. And there's also another document that's interesting, and all this is on the platform, is the 2015 standards for revised Pillar 3 disclosure requirement. Remember, disclosure, I've said it and we'll see it just after, is a very important aspect of corporate governance. Now, these principles are, and these guidelines, more than principles, these guidelines are specific to banking and financial institutions, but they do follow a general framework regarding corporate governance that can be found in the OECD Principles of Corporate Governance. And the OECD Principles of Corporate Governance are not specifically focusing on the financial sector. These are just focusing on any type of firms. And so the Basel Committee actually elaborated from this basic foundational framework of corporate governance to adapt it more specifically to the financial sector. Now, what do we call corporate governance? What is corporate governance? The simplest way to identify corporate governance is to say that within corporate governance, you find the system by which companies are directed and controlled. So within corporate governance, of course, part of it relates to corporate laws, okay? And that's the national laws that will apply to a firm, okay? The company law. But corporate governance is much broader than that. It is not limited to company law. Company law is just one aspect, the legal requirements of how you set up your company and how it is run. But the corporate governance tries to go much further, and it gives a framework that takes into account the various stakeholders' interests and says, well, you have to balance them out. Now, this is the commonly understood notion of corporate governance. Of course, you do know that there has been a tension between what is called the shareholder model and the stakeholder model. The shareholder model was basically defended by an economist called Friedman. He was basically saying that the only objective of a firm is to maximize the shareholders' profit, and that it is not for the firm as a private organization to worry about the stakeholders' interest. So stakeholders are, for example, suppliers, employees, the state, the environment, those kind of things. The stakeholder model, on the other hand, says, well, the firm, because it has an impact on the economy, on the society, and on the environment, has to take into account what are called the externalities and things like that, and the negative externalities and those elements. And so corporate governance today, in terms of content, is about balancing out the various stakeholder interests. But by saying this, we're not saying that the firm is not there also to maximize the shareholders' of course, wealth. It's just that it has to balance out those elements. So it's about balancing this out. And the second element, important element that you find within corporate governance is that it gives you the guiding principles on how do you organize the relationships that will exist necessarily between the management, the board of directors, the shareholders, the minority shareholders, and other stakeholders. So that is why corporate governance has to be understood as the system by which companies are directed and controlled. The OECD principle of corporate governance gives a very good definition of this, because it says that corporate governance actually is a set of relationship between company management, boards, shareholders, and stakeholders. Okay, and it is of course also through the corporate governance that you will find the strategic decisions that have to be made. So basically, it's an important, a fundamental element, a crucial element of firms. Now, corporate governance is interesting, and this chart shows what are the different factors that influence the behavior of a firm, and that, to say it differently, that discipline a firm. Of course, you have, and corporate governance is part of the internal factors, you have the internal organization, shareholders, board of directors, management, and of course the relationship, the reporting, and the appointings and the strategic decisions that are made, means that you have internal relationship. And so you will find corporate governance, of course, here within the organization, so the black box of the organization. And so when we talk about compliance, it's internal. But you also have to understand that there are external factors that have an influence, that discipline the firms. You have private external, and you have regulatory, or you could also call public type. So the regulatory are, of course, the standards, the laws, the regulation, but financial markets, of course, they play an important aspect. The competition will also have an impact on the behavior of firms. And then you have private factors. And one of the most important one are the stakeholders. When you have, and I'll just take one example, when you have in today's world in the public opinion, the awareness about, for example, the environmental protection, or at least having models that are environmental friendly, that's an external factor that has an influence on the firm, because it cannot decide without taking into account. It doesn't mean that it subordinates its mission to protecting the environment. It means that it cannot decide about its industrial processes or the investments that it makes without taking into account that decision. So that's a very strong external private factor, stakeholders, that will play. And if you look at it more technically, here in this box, you have a set of what are called reputational agents. For example, lawyers, credit rating agencies, research, things like that, corporate governance analysts. These are accountants, of course. These are professionals that, through their own activity, have an influence because they assess the reputation and the behavior of a firm. And that is why they are called reputational agents. They have no direct powers over the firm, but because of what they deliver, analysts, for example, analysts will provide different studies and works on firms. It has an influence on the firms. And so this first chart shows the complexity of devising your compliance and your internal corporate governance, because you cannot avoid at least taking into account these external factors. Right. So this is where corporate governance obviously plays a very important role. So the conventional definition of corporate governance is, as I said, based on the fact that these are general principles and compliance processes that organize the direction, the actual management of a firm. The birth of corporate governance outside of company law can be explained between what is called the agency problem. There's this very old understanding of the disconnection that you have between owners and managers. And you often have the situation where managers are going to be in a self-serving type of attitude. And sometimes the incentives of managers will not be aligned with the interest of the owners. Okay? And so there's a transactional relationship that has to be put into place in order to align the behavior of the managers with, of course, the interest of the owners. It's a very, very old idea. Adam Smith talked about it, and he had a very simple illustration for that. He used to say, the owner of a horse will always take better care of that horse than the person you are paying to take care of your horse, because the relationship is not the same. Okay, and so that's exactly what happens in firms, because if the managers are not the owners, then obviously their behavior doesn't follow the same incentive. Okay, and the other thing is that the time frame is not the same. An owner is in a long-term time frame, whereas managers can more often be in a short-term relationship. And so the decisions that are made will not be the same. And that is why the corporate governance deals with disclosure and authority. How do you create systems that balance out the disconnect between owners and managers? And that's why we talk about an adversarial relationship. So that's where we stand regarding corporate governance today. And corporate governance, since the 1990s, is actually an approach that is quite broad in scope. Okay, it takes in the wider context. It is usually considered today as consisting of 5 elements that boards have to consider. And the 5 elements that boards have to consider in terms of stakeholder approach are the long-term strategic goals, the employees, the environment and community interest, okay, the environment that I'm in, and so the environmental consequences of my act, the communities that I'm serving, the customers and suppliers, and of course, the legal and regulatory aspects that are related to compliance. If you see that those 5 elements that have to be considered under corporate governance, and so that might translate into specific internal organization, you see that it is very broad in terms of context. Now, that context has become even broader over the past few years because of the development of what we call sustainable development. And there is a real link between sustainable development and finance. There, of course, is a clear link between the sustainable development and other types of industries, but even with finance. The bridging, okay, the relationship between, or the filling in of the gap between finance and ethics over the past, let's say, 3 to 4 decades, has been accomplished mainly through what has been called asset allocation strategies and policies. Okay, it started off with very simple elements, what used to be called a deontological approach, and that focused on what were called sin stocks. So bad stocks, bad reputation stocks. For example, we will not invest in a controversial sector. So, for example, we will not invest in arm producers. We will not invest in adult entertainment, in alcohol manufacturers. And then that gradually moved towards more sophisticated approaches called positive investment, or thematic investment, impact investment, engagement, and things like that. And this gradually evolved from the late 1980s up till now to this actual consensus regarding sustainable development. And that consensus is pretty young, actually, okay? Because I won't go into details, but we have a series of famous international, let's say, treaties and conferences that took place. The Rio de Janeiro 1992 United Nations Conference on Environment and Development. Before that, in 1987, there was the United Nations World Commission for Environment and Development, and they produced what is called the Brundtland Commission. And all these documents, these conferences, have set forward an agenda, including and regarding the sustainable developments. This idea that there is today a much clearer and a much more materialized topics regarding what is sustainability and how it has to be considered. And so the actual consensus that has spread over, okay, because both politicians, management, and societies, public opinions, have adopted this sustainable development objective. And sustainability, and this is the actual consensus, sustainability has to be materialized in environmental aspects, or environmental protection, in economic growth, and social progress. Okay, and it's the meeting of these three elements. So socio-economic elements, social and environmental element, and economic efficiency, that mean when they meet, you have sustainability. Okay. And so in this chart, it gives you all the different elements. It gives you an idea of what you have into these different elements and how they get together in order to actually deliver a framework of what is sustainable. Now, of course, this doesn't take care of all the questions, and probably one of the most important questions today for what is called intragenerational justice is what is a fair distribution when we talk about equality, needs, and performance of firms. When we look at the economic growth, social progress, and environmental protection, we see what is intended, but this doesn't give a clear definition of what should be done. And that is why the compliance approach has become so important, because that is where the compliance approach has to give answers within the firms. One of the last element, and I'm just quoting it, I'm not going to in any detail. One of the last elements that I think is important is what is called the United Nations Principle for Responsible Investment, PRI, that followed the Environmental Program for the Finance Initiative, and that had a lot of signatories. These PRI, Principles for Responsible Investment, that were adopted in 2006, they actually laid down 6 principles for responsible investment. And this is what is actually being dominant today. And these are the principles that the COVID-19 crisis is actually, I would say, moving forward. Actually, it's driving all national financial systems and the economies to actually go down the road of those principles of sustainability. And so I think this is an important aspect, because that is the world that we live in today. But sustainability, as you can understand, is a very, abstract concept. So we try to materialize it through these different elements: economic growth, social progress, environmental protection, but it doesn't give the answers. And this is where CSR plays an important role, and a growingly important role over the past year. So what is CSR? Well, CSR is about corporate social responsibility. It is something that, of course, is operationalized through corporate governance, but that is larger than corporate governance. CSR is actually concerned with treating the stakeholders of a firm ethically or in a socially responsible manner. You treat stakeholders in an ethical way or in a socially responsible manner. And we know that stakeholders, they exist within the firm, for example, employees, shareholders, but also outside the firms, the environment, the state, the suppliers, the customers. And so consequently, behaving socially and responsibly will increase the human development of stakeholders both within and outside the corporation. One of the general ideas that comes out of CSR is that actions taken by firms towards society and the environment have to be over and above their legal obligations. And that is why this chart here shows how CSR, corporate social responsibility, actually is related to different concepts that should be distinguished. Okay, it's not just one melting pot. There's a general, let's say, overview, the corporate social responsibility, that has become today the mainstream, I would say, context. Within that, what we do find is we find corporate sustainability, corporate governance, and then corporate citizenship. So corporate citizenship, and I won't be talking about this, is about the sponsoring that firms will engage in, the humanitarian aid, the charity that it donates to, those kind of things. Corporate citizenship. This is a much more fuzzier concept than corporate governance. Corporate governance relates to very specific aspects: the internal functioning, the anti-corruption objective that you set up within your firms, the reviewing internal assessment process. That's about corporate governance. Corporate sustainability, and we'll have a pause after this, addresses what is called the triple bottom line. And the triple bottom line is this idea that a firm have 3 types of responsibility. But you see that we're talking about corporate sustainability. We're not talking about specific rules that will apply. That would fall within the rules and regulation, which is outside of the corporate governance. Okay, it's part of it, but it's not the corporate governance. The triple bottom line is that there's an economic responsibility, by firms. There's an environmental responsibility, and that is quite clear today, and that is being enforced more and more. And there's a social responsibility, okay? Work-life balance, healthcare, diversity within the organization, things like that. Now, all these elements are important drivers of the design of the way you manage and the compliance process. But you see that they are of different nature. For example, if I'm a financial institution, it is clear that the capital requirement triggers a set of internal compliance processes that are mandatory. But the corporate sustainability also forces me to come up with, I don't know, for example, my gender diversity or gender representation compliance, my diversity compliance, my work-for-life balance policies and things like that. But it's not of the same nature, and still it is part of the responsibility. So it can engage the reputation of a firm. And so it is not just a general guideline, it has direct consequences on how a firm actually operates and functions. Okay, so those are the general elements of the corporate governance that are important. And after that, we'll have a pause, a 15, 20-minute pause. I think it's what, it's 8:30. Yes, it's 8:30 in Vietnam. So I'll give you we'll take 15, 20 minutes, and then we'll finish on example of corporate governance and the Kobe Steel aspect that explains how that functions. And the Kobe Steel is interesting because it's a 20-year-old case, but we can look at it today and understand it and see the lessons that can be learned from that, having in mind the sustainability and the CSR context that 20 years ago was not as clear as it is today and was not mainstream as it is today. All right, so I have a pause, and once again, I insist, do not hesitate to ask any question and to come up with observation and remarks if you have any. So, pause. I'll be right back. Okay, so before looking at the Kobe Steel case, just a few more words about the corporate governance to finish on that point. You will find in the slides more precise definition and explanation of what is corporate governance. At its basis, as its root, initially, as I said, it's addresses the separation of ownership and control, and to try to align them both. Except that we know that today, where the main objective initially was to make sure that managers had an incentive to behave in a way that would not compromise the interest of the owners, today corporate governance takes into account CSR and sustainability as a wider perspective. Okay, so it's the stakeholder model. It's important to understand that because that explains many of the new elements that we find in the compliance and ethical thinking that has to be some way or another operationalized through corporate governance. I mentioned Adam Smith, so you have the citation in the slide here of how he identified the agency problem. Remember, this was written in 1776. Now, the actual theoretical framework is often related to Burl and Means. I'm not going to go into any details here, but just so that you know, Burl and Means, they wrote a famous book in 1932 trying to explain the financial crisis of 1929. And in their analysis of the situation, the agency problem in the firms operating at that time came up as the main source of difficulties that led to behavior that created the 1929 financial crisis. And so that is why it is a famous starting point, if you want, for the enhancement and the development of corporate governance in the 1930s. And so how do we align, as I said before, since you have a separation of ownership, shareholders, and control, and because of that separation, managers do not have a very good incentive to operate the firm efficiently. You need to align the behavior, and that is done through laws, of course, and corporate governance. I insist on the fact that laws and corporate governance are two elements. Of course, laws can impose corporate governance, but the content of corporate governance comes out of corporate governance charters, codes, and things like that, not out of the laws. The company laws have a much more restricted scope, and they address very institutional aspect, whereas corporate governance is about the behavior, the decision-making process within an organization. Now, where things changed over the past 30, 40 years, it's within the term efficiently. As I said again, and I'm just repeating it differently, initially, to manage a firm efficiently was for the managers to make choices that would maximize the wealth of shareholders. To manage things efficiently today in the sustainable development context and the CSR context is to make decisions that will, of course, maximize shareholder wealth, but at the same time, take into account the other stakeholders' interests, and so balance out that. Okay, so it's in the grid to assess what is efficient in this context that has really changed. It's not the mechanism in itself. I'll skip this, and I just want to finish this before looking at the Kobe Steel, to finish off on a last, I would say, insight about corporate governance and the difference that we find across the world. Okay, it's about the different models. So the question is, and the answer is yes, of course, does cultural differences play a role in corporate governance. Obviously, they do. We've already talked about it. It's fundamental. But it goes a bit further. The capitalism in the 21st century, or at least in the early 21st century, since it's only 20 years old, is actually a collection of different types of economic systems. They all fall under the heading capitalism in terms of functioning on markets and on open markets. But of course, the global system, the economics, not the global system, sorry, the local economic system is different. I mean, the Vietnam market's not function as in France, and in France they function within Europe, and the French market is not exactly the same one as the German one, and things like that. So there are local differences, and those differences translate into who is in charge of corporate governance. And so that has consequences on how you organize your corporate governance. And to try to be a bit clearer on this, remember that there are different contexts, economical contexts. Now, if we take the US, United States of America, you have this idea that you have a lot of corporations. Right? You have numerous corporations. There's a lot of competition. CEOs have very strong powers, and the boards are usually quite passive, and you have large numbers of shareholders. And so the American model rests a lot on this corporate governance, because the firms are not controlled much by one group or one investor, and so the corporate governance plays in that specific context. If you look at other places in other parts of the world, you have very different types of approach. For example, you can have wealthy families that have controlled firms, or you can have very strong links to governments. Okay, you have monopoly-like organization. If you take the chaebols, for example, in South Korea, and so each local context will have an impact on the corporate governance. And that is why it is important to understand that basically we can distinguish at least 4 different types of capitalism, what we would call shareholder capitalism, family capitalism, bank capitalism, and state capitalism. The common factor here is that all of these models rest on open markets and competition, but the way the capital and the firms are controlled is different. Shareholder capitalism is this idea that capital is allocated through a market mechanism, and you have a lot of shareholders. Family capitalism, it's when you have families that hold, and so the trust here is to the persons, not necessarily to the company, and the market mechanism doesn't play an important role here. So the discipline that can come from market doesn't play. Bank capitalism is when you have bankers that play an important role in the governance of industries, because they are the main providers of funds. Okay, the French capitalism, for example, for a long time was not only, but there was a lot of bank capitalism. They played an important role. And so the control over the managers doesn't come from shareholders, but comes from these major or institutional investors. And state capitalism is when you have public officials that supervise the management and the governance of firms. And you find that in different economies. France also had a lot of state capitalism up till the late 1980s. And then because of the evolutions in France and within the EU, the model changed. The reason why I mention this is that obviously the standards that you're looking at in terms of compliance, ethics, and corporate governance, how you organize your process, will not be the same depending on the context, the type of capitalism that you are within. And so you should never forget this. So even if we have these internationally agreed upon general principles. The reality is that the culture, the economical model does differentiate the actual implementation of your corporate governance. And here you'll see the slides that explain why countries have, taken different paths. But I'll set this aside because I want us to get to the co-BCL. So corporate governance is actually implemented through. Sorry, it's not implemented. It's implemented at the firm level, but it's usually based on written principles or guidelines, and these are what we call corporate governance codes or corporate governance guidelines, or the best practices. These I would say these books of principles, these documents that try to gather the corporate governance principles, are usually elaborated by union or associations of directors. They are only normally soft law, but your national laws might make it mandatory that you have a corporate governance. It's not going to tell you what's inside. They want you to have your corporate governance rules. So what is your internal assessment process? What is your corporate what is your decision-making process? Who reports to whom? What are the disclosures, internal and of course external? Of course, listed companies are usually subject to mandatory disclosure because, as you know, the functioning of the financial markets rest on that disclosure or relies heavily on that disclosure. So it's usually mandatory for listed companies. But once you're not a listed company, when you're outside of the realm of listed companies, quite often the disclosures are imposed through the corporate governance principles or the best practices, but not by the law. Okay, it's not the financials market regulation that imposes it. And of course, you have to be aware that corporate governance has been very heavily influenced by the Anglo-American practices. Of course, these influences now are much more diverse. They're much more open-minded to a certain extent, and the maturity of the different markets across the world is such that today, for example, I see it in France, so I assume it's probably the same in Vietnam. In France, for example, for many years, the business communities in France were impressed by the American approach, and so they were not very critical about it because they felt they had some kind of inferiority. They lacked the same knowledge. After some time, where you have people that are more internationally trained, that move back and forth across different systems, then you move away from that influence, and then you can come up with your own approach, and you can oppose them because you consider you have the same knowledge, and so you can debate about it. So this is what has happened in France, and so I'm sure that in other parts of the world, it's exactly what is happening also. But still, there was a bit of this one-size-fits-all approach for many years. It's only recently that we've seen a change. I mentioned this because I think it's very important for anybody today to understand that if the mainstream American approach is definitely something to look into, and it's interesting, it is not the mandatory one. It's not a one-size-fits-all. It doesn't work like this because of what we just said just before, because the context can be quite different. Okay, and so, of course, what is constantly within corporate governance is the accountability, the decision-making process, and the disclosure element, and that is what the Basel Committee came up with in its specific governance for banks. It's to focus on that, but it is not telling you how to implement it. That is something that has to be decided depending on your culture, your laws, and your local laws and regulation, and your local economy, the configuration of your economy. So I think it's important to understand this. Now, basically what you find in corporate governance, and I'm not going to go into any details, in the slides, all these different items are detailed. Corporate governance is about allocation of authority and responsibilities. Okay, that is quite clear. So what we mean by that is that the manner in which the business is governed, and here I'm talking about banks, but it's true for the corporate governance in general. And so the different elements that will be addressed are board practices, the responsibility, the qualification, the practice and structure, the group structure. How do you structure your group? The relationship that you have between senior management and the board. How do you set your compliance offices, your business ethics, et cetera, okay? Some items pop up. For example, and I'll send you a link also if you're interested. For example, digitalization and IT for many years was not an important element for the board to consider. Today, especially after the COVID-19 or during the COVID-19 situation, because of the importance of using digitalization and IT within the overall functioning of your company, suddenly that element has become a subject that the board has to look into, because it becomes a source of risk. It's an element of the strategy, and so it has to be addressed by the board. So within those structural items that you find in corporate governance, the elements that are considered, of course, will change. All right, so those are the main elements I wanted to look into. The last part here, combining pillars, is really related to the Basel. So you can look into it, because you will find here the different principles that are in the within the Basel's corporate governance principles for banks. And what I've put in the slides are the detail of what each of these principles refers to. Okay, so I'm not going to go in details because we do not have time, but you can look into it. Of course, if you want to have more elements. What I'd like us though to do is to actually look at sorry, it's not here, at the case, which is the Kobe Steel case. So I'll switch the presentation. Okay, so the Kobe Steel case is an interesting element of corporate governance. In this set of slides, which is about the case the case studies, you will find a presentation, a very synthesized presentation of the different cases that you have on the platform. So if you read the cases, they're usually quite self-explanatory, but here with the slides, it goes straight to the point. So all the different elements are actually identified here in the slides. I'd like us, sorry, wait, I'll go directly to there. The Kobe Steel case 7, Kobe Steel, which is about changing corporate culture. Now, to understand this case, you have to understand what happened. In order to do so, before I explain exactly what happened to Kobe Steel, just a few words of context. Kobe Steel is over 120 years old, because it was founded in Japan in 1905, so just at the start of the 20th century. It became Kobe Steel Works in 1911, and in the last years it became a multinational, was ranked 4th or 5th company in Japan, and in terms of steel production, I think it was the 4th or the 5th steel producer in Japan, and it's in the first 30. It's in the 30 biggest steel producers in the world. Its principal business is welding material, aluminum, copper, but also machinery, construction equipment, electronics. And over the past 15 years, it really went into the information-related industries, the data and things like that. It's a huge group, has over 30,000 employees, has, of course, a very high capitalization. I think it was over 250 billion yen. And it has firms all over the world. And I think up to 30% of its group revenue come from operations outside Japan. Okay. So that's the firm. What happened is that there was a scandal. And in order to understand that, we're just going to listen to it was a business journal on TV, I think it's Al Jazeera, that a few years back, that explains, it's a 5-6 minute, that explains very well what happened. So this is just about what happened, and then I'll explain to you what this scandal triggered in order to change the corporate culture, and how Kobe Steel went about changing its corporate culture. What did it do in terms of corporate governance, in terms of ethics, in order to change its corporate governance? All right, so that's the scandal that Kobe Steel had to face. But that scandal that we just heard about was in 2018. This case that I'm going to talk about right now, it is with Kobe Steel. It is a corporate governance cultural change. It is what triggered this corporate governance change. But that was in the year 1999, 2000. So the reason why I showed you that last scandal, it's to show you that between these two dates, right, there was a total change of corporate governance culture, of corporate culture, right? And so in a certain way, it's interesting to see how formally modifying your corporate culture, embedding specific elements is not sufficient and takes time. Now, what happened in the years 1999, 2000 is that there was a corporate restructuring of Kobe Steel in 1999. And in the course of this corporate restructuring, Kobe Steel, the management, discovered a violation of Japan's commercial code. They discovered that 3 of Kobe's top executives were suspected of having paid what are called sokaya racketeers, okay? So big muscle man. And they paid them so that the sokaya would help them make sure that the shareholders meeting went smoothly, okay? To avoid having people that would, you know, come and maybe challenge the decision of during the executive, the shareholders meeting. So this was a violation, obviously, of the laws, because it was a way to prevent people and shareholders from exercising their rights. And so there was an inquiry, and what came out of this is that for 11 years before that, there had been these kind of practices. What the investigation also showed was an act of corruption. Why? Because some Kobe Steel executive had actually made a few million of dollars contribution, political contribution, while using the ambassador of Venezuela in Japan in order to help a candidate for Venezuela's election, presidential election. And so in 1999, 2000, the scandal broke out with a legal action for corruption and illegal practices, so international corruption and illegal practices in Japan. Now, what happened was that the Kobe Steel company reacted very quickly. It reacted very quickly because it immediately established a corporate ethics committee. Okay, so that was in 2000, a corporate ethics committee. And at the same time, it transferred the shareholders meeting and stock affairs from the general affairs to the legal department. So general affairs department was the one that was in charge of the shareholders meetings, for example, and that was transferred to the legal department. And the legal department, within the legal department, they immediately created a legal affairs management officer. Okay. Now, the committee in itself is interesting because the committee in itself, the composition of the committee was quite unusual for a Japanese company. The president of Kobe Steel was the chairman of that committee. There were 3 board members, but there were also 3 outside experts that had nothing to do with Kobe Steel, and the views expressed outside the company and a strong limitation of participation of company members in the committee was decided and was really enforced by the chairman. And so that was at that time very unusual. The fact that you brought in outside expertise into your committees, or well, in this case it was called the corporate ethics committees, but in Japanese firm it was not a usual practice to bring in outsiders in your committees, which of course is the way you run, for example, in the US. That's how you run the different committees. I don't know, remunerations committees and risk assessment committees. You have non-executive outside members. What the firm also did was that politically, the president announced in the year 2000 that it would strengthen the role of external auditors and would improve the disclosure of matters. Now, the Corporate Ethics Committee worked, and they came up with a set of measures. And by the end of 2002, they decided that there were a set of measures that should be adopted. First, drafting of a code of ethics. Then, having an ethics consultation office within the firm, a bit like if you have a hotline, okay? But that was more, it was a set of people that would be allocated to work on the ethics and ethical aspect. They would have to also to enhance the internal controls, okay? So reinforce that. That's really within compliance. Engage into compliance training extensively, and that is part of the requirements that you always have in corporate governance code. You need training of your personnel. It's part of the corporate governance. It's part of, and we saw that when we talked about business ethics. The only way to promote business ethics is through also training, ongoing, continuous training on those issues. They decided about on the creation and distribution of manuals regarding ethics and corporate governance, so making sure that the different members of the firm, from the low-ranked personnel to the top managers, would have manuals giving them the framework regarding the ethical behavior and regarding the corporate governance type processes. And finally, they decided to set up a compliance-related reporting system for early prevention or for minimization of risk. That functioned also through kind of the hotline. Now, a quite extensive set of measures that would come into play in order to address the failures of the corporate governance within the company and the group. And it's important to understand that, because that is how they were pushing forward a change of corporate culture. Okay. Now, the Corporate Code of Ethics was released early 2000, and they prepared it by looking at other codes of Japanese companies, but also by going out, reaching out and benchmarking codes of corporate governance from other parts of the world. What's interesting is that when that first scandal arrived, so remember I said 1999, 2000, so the company was 90 years old, now it's a bit older. It had nothing within the organization, it had nothing that resembled a company code or a statement of corporate philosophy or a statement of corporate ethics, business ethics. Okay, it had nothing like that. From that time when it enacted that code up till now, this has become the central point. The code has become the central point, the focus, the locus of corporate ethics. Now, of course, you could say that it hasn't been that efficient because 18 years after, you have the second scandal that we just listened to. But still, it has improved other elements. This code of ethics covers a lot of elements, but basically, I think what's important to understand is that you have, of course, principles, and then you have implementation process. All that is in the governance code. The code of conduct, as they call it, will cover things such as relationship with client, and so all the gift policies and things like that. The relationship with suppliers. Okay, how do you select suppliers? The transparency, disclosure elements. What is socially acceptable in terms of relationship between employees and suppliers? Relationship with affiliated companies and partner companies. So within the group or with other, for example, third-party transaction and things like that. And relationship with ministries and local government. Okay, and that was an important aspect. And then you have a series of elements within the corporate governance code of Kobe, or the code of conduct, as they call it, that actually goes into the implementation. And so this is a very important aspect. So the code comprises one part on the principles that are laid down, and another part on the implementation. And here for the implementation, and I would just like to take a few minutes to explain the implementation. The implementation system is the main point of interest, actually, of the Kobe Steel's compliance system. Now, the implementation of the corporate governance principles and the conduct principles of Kobe Steel are in the hands and are the responsibilities of the Corporate Ethics Committee, as well as the compliance managers and the Ethics Consultation Office. So the Corporate Ethics Committee, I've already talked about, but it is responsible, it is the top level responsible for monitoring compliance with laws, regulation, and to coordinate all the elements that are related to the code of conduct. Then there's an organization where the corporate ethics committees has to meet 4 times a year, and the issues that are discussed within the committee are reported to the board of directors. So not all of the detail, but as needed. But there is a systematic report to the board of directors. And remember, there's this idea that compliance has to reach the top level of management. Then there's communications and training, and so that has been an important element of the code of conduct. That is the means to change the culture. So the objective here is to make sure that officers and employees are aware and know about the expected behavior, okay, the business ethics, the risk limits, the risk appetite limits, the reporting that is awaited from them, and things like that. Now, this is something that was unusual at that time, in the years 2000, is that the corporate ethics handbook, okay, the manual that we talked about, that were drafted, were made public to the greater public. Okay, it was made accessible. It was not, and this was very unusual in Japanese firms. And then they embarked in compliance, education, and training to raise the awareness. And so that's a very important aspect, where they they try to organize that training from top to all the way down to the hierarchical line. And there's this obligation, this mandatory obligation to follow your training and to follow on a regular basis. Compliance managers were also set up, and at the different levels. So, of course, at the level of the group, but also within the different affiliates with the subsidies, and you have a system of reporting between the different compliance managers. And compliance managers have to make periodic reports on the implementation to the corporate ethics committee. And finally, still part of the implementation is the establishment of an ethics consultation office. Now, the ethics consultation office for employees is interesting because they created a hotline. So they made sure that the office could be reached by telephone, fax, email, whatever. But in practice, they realized that the ethics consultation office was not often called. What were much more frequent, though, were the discussion with the officers that are responsible for human rights matters, and that have to be designated in every of the facility of the group. So every facility has to have a human rights matter officer or a compliance officer to field in reports and provide consultation on all the ethical aspects, including but not limited to, sexual harassment, gender discrimination, equality, discrimination, and things like that. And so what's interesting, because this is a very interesting lesson from the Kobe implementation system, is that the most efficient aspect of in order to deploy a change in corporate culture and to enhance the ethical and compliance approach is through constant training and through individual relationship within the firms at the different level. You need to have somebody that an employee feels sufficiently comfortable with for him to reach out to. If you only have a very hierarchical, abstract organization, what happens is that it exists on the paper, but it doesn't really translate into real life. Okay. And so that's an important element that was set forward. And I think what's interesting with the Kobe Steel example is that it shows exactly the extent that you have to go through in order to create within your organization this corporate governance culture, knowing that in today's world it is even much more complicated because you have to add the CSR aspect, the corporate social responsibility aspect, with the social and environmental considerations, okay, which means it has expanded the scope of this compliance, and you have to be impactful minded when you set this up. But this is a very good illustration. Now, of course, one of the reasons why I showed you the little investigation carried out by journalists and earlier is so that despite having done all this, okay, and all this was operational by the years 2002, 2003, it did not prevent the 2018 scandal, meaning that you have to be humble about these organizations. It is never, I would say, totally bulletproof. Okay, it is never totally breach-proof of the corporate governance and of the ethical requirements, and that means you need to have constant pressure in order to avoid that things go out of track at one point. It is an ongoing, a permanently ongoing process in order to have a well run and a compliant system within your firm. So this points out that two things, and I'll finish on this. First is that even more so in today's world, the compliance and ethical approach is fundamental. And it is not just a general, abstract, theoretical requirement. It breaks down in very practical aspect of the organization. And at the same time, you have to understand that if firms are going to be more and more so scrutinized at how they perform on those elements, it is also something that you can never totally, completely secure and address within your organization. And so that should teach us to always, when you're looking at those issues within your firm, always know that things have to be set up in such a way that you're always reflecting and considering and evolving on your processes and on your reporting system. All right, so this brings us to the end of these lectures. This last part should help you in understanding the Enron case. So you watch the documentary, which actually is going to explain and give further example of all what I've been talking over the past sessions and today, and shows the failures and what are the reactions to that. And there are two types of reaction that you find in any system. You have formal rules that are being adopted, so laws and specific regulation, and you have enhancement. You have improvement of the corporate governance processes and substance, okay, and principles that have to be carried out. And that's the world that we live in today. And that aspect of running a firm, of running the operations, has become a very important aspect of today's firm and cannot be overlooked. All right, so I think that brings us to the end. Of course, if there are any questions related to this, final assignment regarding the Enron case, please do not hesitate. You can ask questions right now, or you can send me an email later on if you have questions that are later on. My final observation, my conclusive observation, would be, regarding compliance and ethics, you have to understand it as hunting for failures. Okay, hunting failures is I think that the driving, the general idea behind all these processes. It's not setting up processes just like this. You can meet the stock exchange corporate principles if you are a listed company. It's not just to meet the public opinion requirement. It's because you have to hunt the failures that come out of non-compliance, of unethical behavior. And it's not just for the beauty of it, it's because there are consequences attached to that in terms of reputation, in terms of potential liabilities, and that has a cost for the firm. So hunting failures in order to improve the performance of the firm is the rational role assigned to compliance and ethics. All right, so this brings me to the end. And if there are any questions, feel free to ask them. And if not, I will just say goodbye, because we will not meet again. This was the last lecture, and well, I hope that you did learn some things along the road. And I hope that I might have a chance to cross your paths in real life at one point when things do return to some kind of new normal. We don't know exactly what it will be, but the world tomorrow, or after tomorrow, or after tomorrow. All right. Well, if there are no questions, I will say good evening and good luck with the assignments. Do not hesitate to send emails if there are any questions that you might have regarding that. And thank you for your patience following this behind these horrible screens. Goodbye to all.